Good evening, traders and investors. Will back here with another one, coming to you with a Wednesday market recap. Hope all of you had a very good day of trading today. And in today's action, guys, well, the bulls coming in with a third day of consecutive rally in a row, now completely undoing the damage that was done on the Monday session, which was a result, of course, of the tariff news coming in over the weekend. The bulls had a very nice broad market rally today. It was not a top-heavy, tech-heavy rally, really all sectors coming to contribute to the party. Now, a lot of that was due to two pieces of news events that we got this morning. Number one, the services PMI result that came in and showed that services inflation was still relatively under control and trending downwards in the right direction. The second piece of news, of course, was the jobs market still being very healthy, with a private ADP jobs report coming in better than expected. Those two things led to the downside in the yields market, which, as a byproduct, guys, we know that equities do enjoy when yields continuously come down. So overall, guys, a very nice day of broad market. However, we know that even though 3 days of rally is nice, until we confirm that new daily uptrend, we are not out of the woods just yet. So in today's video, guys, we got a few things to go over. Number one, we're going to be taking a quick look at exactly what happened in terms of those news releases and their potential lasting impacts on the market. Number two, we're going to go through 3 company earnings that I had prepared for you guys. One is going to be Uber, number 2 is going to be Walt Disney, and number 3 is going to be ARM. Now, I know there's a few other ones such as Novo Nordisk and Qualcomm, but unfortunately, guys, due to time constraints, I can really only cover 3, so I figured I would cover those 3 specifically. Tomorrow, another big day, of course. Eli Lilly, huge healthcare player on the tape for tomorrow morning before the open, and then Amazon, Elf, Cloudflare, Affirm, Fortinet, some other plays to pay special attention to. The biggest one, of course, is going to be Amazon. And as such, we start winding down our big tech earnings season. All of our big tech players after tomorrow will have reported. So we'll be covering those 3 for you today: Uber, Disney, and ARM. Thereafter, we're going to take a look at our price action, technical analysis, and set a gauge as to whether or not these are interesting levels to participate for some trades on our market indexes. And thereafter, take a look at our big tech names as well and see if there's any deals to be had in big tech after this earnings season. And that's going to be it for today, guys. No portfolio update. That will be on the Friday video that I will be filming on Saturday this time around, because I'm leaving Friday, guys. Won't be here Friday. Have a flight over to Japan, but I will be continuing the videos for my stay in Asia, which should last about a month come the Friday time. So guys, a lot to cover today. Let's jump right into it, shall we? So moving into the SPY, up about 0.41%, the Q's up about 0.45%, and overall, guys, very nice broad-based rally today. No major sectors getting left behind, and you can see that even better on the heat map. Although we did have a slight weakness here, Google after their earnings coming down, Amazon down a little bit as a result of those Google earnings, namely because of the weaker than expected cloud growth. We know that Amazon is the largest cloud player on the entire planet at the current time. So whenever you get weaker than expected cloud numbers out of Microsoft and Google, it can kind of hint that maybe Amazon is going to be weak as well. But that's just speculation. Their numbers come out tomorrow. Tesla taking a little bit of a hit today as well, 3.5. But overall, guys, you can see very nice broad-based rally today. And a lot of that, as I said, was as a contribution from yields coming down. Now, moving on to the one-day relative, you'll see that even better. Most of the market was indeed green today. Communication services was down. That is largely a byproduct of Google being down 7 and Meta relatively ending flat. And consumer cyclicals were down as well, about 1.19, but the rest of the market doing quite well. Where do we stand on the 1 week relative? Well, we've now undone a lot of the pain that was caused over the past week due to the tariff headlines. Overall, the market is looking quite healthy. The only 2 sectors to the downside remain industrials and consumer cyclical. But overall, on the 1 week or even on the 1 month, guys, it shows that we're kind of getting through a lot of the pain that was caused through the December and early January period. So I do not see any major red flags in the market so far just yet. Now, before we get into earnings, let's do a quick little recap here of what's been happening on the macro front in the last few days. So on Monday, we were greeted with a more than favorable than expected manufacturing PMI report. Now, this was one of the concerns in the past few months. The manufacturing sector was relatively weak for a few different factors. However, we can see that the manufacturing sector is slightly holding. Yes, holding around lows, but is not getting significantly worse. So that was piece of data number 1 that showed that the markets and the economy was still on solid footing. Number 2 was yesterday, of course, the JOLTS jobs openings, which came in under the expectation, but it's always a toss-up to know whether or not there are less job openings because more people have actually got jobs, or whether there's more or less job openings because companies are just hiring less. I think it's a byproduct of the two at the same time, but overall, the number came in relatively close. You wouldn't want to see this one fall off an absolute cliff, because that would show you that there might be a little red flag that you have to explore a little bit more. But overall, decent data this week through the Tuesday session. And then we come into today. So the private employment change ADP report, 183K versus the 150K expected. The market really liked that, guys, because it was not too hot. It was kind of like a Goldilocks number. Too hot, and you come into a situation where, as Jerome Powell stated just a few short weeks ago, he does not want the labor market to overheat. And this, in my opinion, is not synonymous with an overheating labor market. The numbers coming in just right was a beat, showed the jobs market is still relatively healthy. And the number of the day, of course, today was the services PMI, coming in under the expectation measured through ISM. The S&P Global Composite PMI as well was slightly in line, but overall, you do want to see this services number continue to trend down, because we know that the stickiest portion of inflation so far has been the services segment. So it's always a welcome number to see when your ISM services PMI is coming down. So the services business is still doing very well across the United States, but in terms of prices paid, those are coming down marginally, which is exactly what you want to see to bring down services inflation. So these combining factors led to the drop in yields today, which equities really appreciated to the upside. So that is your quick little macro recap, guys. Overall, as a whole in the markets, we still sit somewhat in the fear read on the S&P. There's a few market indicators that are still somewhat weak. Market momentum is still weak. We've been largely range-bound on the SPY for roughly the last month and a half at this point, so no surprise there. In terms of stock price strength, the net new 52-week highs and lows on the New York Stock Exchange, although we have improved from the midpoint in January, we are still relatively low in relation to the last 1 year's worth of trade, so that is why this one still reads extreme fear, but conditions have been improving. Stock price breadth, we paid a lot of attention to this in the midpoint of January, and it has been improving. If you want me to go through these levels real quick, you can see the percentage of stocks above their 20-day moving average significantly off the lows that we saw end of December and even the midpoint through January as well. Now back to normalized territory. So the broad market has recovered in a meaningful fashion. In terms of the percentage of stocks above their 50-day moving average, a little bit of a longer term moving average there, they're now back up to 50%. Still somewhat weak in terms of the relative highs that we had in 2024, but still significantly off the lows as well. Shows the market breadth is recovering in the proper direction. And lastly but not least, the stocks above their 200-day moving average, 56%. Yes, on the lower end of what we saw through 2024, but definitely out of the depths that we saw in the midpoint of January, where breadth was really front and center on everyone's minds, where the entire market was pulling back and only big tech was pulling its weight in trying to uphold the markets. Now we can see the participation rate from the other sectors has decently improved, and we've been seeing that from financials coming in with a significant rally and healthcare putting in a significant rally as well. Really needed those two sectors to participate, and roughly since the bank earnings midpoint through January, financials came alive, and healthcare has been coming alive as well since pretty much your inauguration date on the 20th, when they really started moving to the upside, when there was no immediate big changes on Medicare, Medicaid spending plans from the Trump administration. So all things considered, guys, even the lower sectors as well have been participating in this rally. So it has been a more broad-based rally, but we are not fully out of the woods just yet. There are still some pain points in the market, namely in relation to the interest rate sensitive sectors, but overall we can say the markets are looking a lot more healthy in terms of internals than they were at the same time last month in January, at the early stages of January, or even the midpoint around January 14th, January 15th. So that is it for your introduction, guys. Now let's get into some juicy stuff, and we are going to cover some Disney earnings. I'll remind you guys, if you want to skip to a certain portion of the video, the timestamps are always down below in the description, so feel free if you want to skip over these earnings. Number one we're going to be doing is Disney. So Disney. I'll remind you of the context, guys. Why did Disney have this tremendous fall over the last few years? Well, they were having problems with 3 lines of their business, their 3 main lines. Number 1, streaming business was not profitable. So we wanted to see the streaming business become profitable to give Disney share price some lift. That has now been occurring for the last 4 quarters in a row. The streaming business is now profitable. Number 2 was parks and experiences. We know that Disney's been struggling with pricing power. When you go to a Disney theme park, everything is already very expensive. And when you raise prices a little bit too much, well, the demand then simply falls off. So Disney's Parks and Experiences division is kind of running out of pricing power. So we were looking to see what can they possibly do to improve that. Now they've put forth a massive renovation plan for the parks, $60 billion for parks and cruises, which should possibly renew interest without having to increase prices that much. They just want to stimulate top-line demand for revenue growth overall, push more people into the parks without having to increase the prices that much. And third was box office fatigue. Franchises like their Marvel movies, franchises like the Star Wars movies, people were getting franchise fatigue. After roughly 5, 6, 7 years of Disney only banking on sequel after sequel after sequel, people wanted new things. And the CEO did listen roughly about a year and a half ago when he also acknowledged, listen, we have to stop only relying on sequels and blockbuster franchise names. We have to start putting out some new content and focusing on the new content. And so far over the last year, they've done a good job at that. So they've addressed all 3 of those prior concerns, and now we can see Disney's fundamentals largely improving. So in terms of this quarter, what we have, guys, is Disney coming in with some very decent numbers. I would not be too upset being a Disney shareholder with these numbers. Beat on EPS by 21.5 and a beat on revenue by 0.10. Now let's go through the article. So we'll only go through the article. You'll see I've highlighted a ton of stuff because the article does a good job of summing everything up. Don't have to go through the company's actual earnings presentation. This article usually did a very good job of summing up the 3 different aspects of Disney's business, what they're working on, what they're lacking from as well. So let's get into it. Disney tops quarterly profit estimates, but starts to lose Disney Plus streaming subscribers. Oh, well, unfortunately, Netflix is just running away with the bag, aren't they? So they revealed the beginnings of expected streaming subscriber losses at Disney Plus. The company's streaming business reported another quarter of profitability despite a 1% decline in subscribers, the company's flagship service. While domestic subscriptions for the platform increased 1%, international numbers declined around 2%. Disney warned during last quarter it expected a modest decline in subscriptions during the December period, and that did happen. Disney told investors that it expects another modest decline in subscribers during the second quarter. So now 2 consecutive quarters of weaker than expected subscribers. As a matter of fact, declining subscriber count. So has Disney potentially now etched out all the market share they can carve? Well, I'm not willing to call it just yet, but they're never going to catch Netflix. That I can definitely say, and that is set in stone. Moving on further, Disney total subscriptions stand at 124.6 million subscribers, a very healthy number. Total Hulu subscriptions rose 3% during the period to 53.6. Hulu, though, is a cheaper alternative of their subscribers in terms of their various subscription bundles that they provide. So although Hulu subscriptions were up, the real moneymaker here is for Disney Plus. And that was down. The slowdown in streaming subscriber growth follows an increase in prices for its services last year. So have they potentially run out of pricing power, guys? You've noticed they've increased prices, and what's happened? They're starting to lose subscribers. What does that mean? The company is quickly running out of pricing power. Who does not have that problem? Netflix, as we just saw with their earnings that I shared on the channel 2-3 weeks ago. Disney Plus's average monthly revenue per paid subscriber increased roughly 4% to $8 due to those price hikes, the company said. Now, this is roughly in line with some of the subscription tiers for Netflix, but it just goes to show, guys, maybe people are willing to pay the subscription increases for Netflix, but not for Disney. As a result, possibly people are deriving that Netflix is just a better service overall, or maybe they just prefer Netflix's service compared to Disney. That is what you have to take away from that. So Disney's net income increased 23% to 2.64. That was about 10.7% net margins. That's roughly how much Disney does on average, guys. 10.7, they're back. They fell off during COVID, but they should be able to come back to about 10.7%. That is roughly in line with what you should be expecting from Disney, even prior to the pandemic. So return to normalization on that front. Revenue increased 4.8%. That's roughly in line with the company's long-term growth rate averages. You can see here through 2027, even 4.6, so I wouldn't say that's a crazy number. It's roughly in line. The company saw revenue gains across the board for its entertainment, sports, and experience segments. The entertainment division had a 9% jump in revenue. However, linear TV continued to drag on overall results. When asked, is it still a good business for you guys to be in cable television? Bob Iger, the CEO, remained positive and said, when it comes to the linear TV business, they are not a burden at all. They are actually an asset, talking about their cable partnerships. Disney is programming and funding the networks so they can feed into streaming. Well, compared to Netflix, does Netflix have to funnel cable TV subscriptions into streaming? No. So even though Bob Iger says it's an asset, possibly they can do without it. Moving on further, we actually feel good about the hand that we have and the manner in which we're managing both the linear and streaming businesses across the board, said the CEO. Now, in terms of the box office hits, Moana 2 topping $1 billion during the Martin Luther King Jr. Day weekend. A very nice box office hit from them. Overall, Disney dominated the box office in 2024 with the help of other films like Marvel's Deadpool and Wolverine and Pixar's Inside Out 2. So although these, you can argue, are sequels and Moana as well, they've been performing far better than the box office hits that Disney delivered in 2022 and 2023. So the box office curling around for Disney. They realized it's a problem, and now they're putting a lot more emphasis on quality content. In terms of the parks and experiences segment, so let's take a look here. Are they able to raise prices at the parks? That is the biggest concern for Disney. At the experiences business, which includes parks, cruises, and resorts, revenue rose 3%. Domestic theme park revenue accounted for 68% of the total. While the revenue marked a 2% improvement over the same quarter last year, the hurricanes Milton and Helene, coupled with declines in attendance and investments in Disney's fleet of cruise ships, weighed on domestic operating income. So revenue's going up, but they're spending a ton of money to modernize their parks, modernize their cruises, and they got hit with the 2 hurricanes. So unfortunately, although revenue is going up, the operating expenses of the business also went up in line, arguably faster than revenue, which is why you have a dwindling of profits. The experiences division posted a 5% decline in operating income for the quarter because of the factors we just described. The experience segment is going to see operating income growth of between 6 to 8% in 2025. That is the guidance. So a lot better than this current quarter, to say the least. In fact, the consumer, here's what the CEO had to say again, the consumer is a bit stronger than we would have expected. I think what we're seeing is consumers are just very value focused. And if you deliver value to them, they're willing to pay the price for it. That's another way of saying, listen, we can't raise the prices forever. We have to provide better value, which is why we're spending $60 billion to modernize our parks and our cruise ships so people actually find value in the services that they're paying and don't feel that they're getting swindled. That's essentially what you have to read between the lines. Moving on further, Disney's parks recently turned a record revenue and profit, even as the company has raised prices for its destinations. But they've raised them very, very, very small. Can't raise them too much because then people will just shy away. Moving on further, sports, the last segment right here, and then we're done. Disney's ESPN reported revenue growth of 8% per year. Arguably, guys, the sports segment for Disney is the best performing segment of the bunch. Operating income was up 15%. Now, it is their more profitable segment and the one that is growing the fastest right now. The broadcaster that's in charge of those services, ABC, averaged 5.8 million viewers for 46 regular season college football games, which was a 56% year-over-year increase. The recent college football season helped lift Disney's advertising revenue this past season as well. The highlight is the college football for the ESPN Sporting Bundle. What are they looking to do? How can they expand the ESPN Sporting Bundle? Well, a few key takeaways here. Disney's been looking into various ways to grow its streaming options, from merging its apps into Disney Plus to exploring different options for ESPN. We're obviously leaning into the development of what is now called Flagship, which is essentially ESPN with multiple elements to it, noting sports betting and consumers' ability to customize the platforms to their preference. We know, guys, that there's so many cable TV and satellite TV packages out there that you can only pay for what you want. If you only want an NFL channel, you can only pay for that. If you only want basketball, you can only pay for that. So Disney is trying to navigate a landscape rather than, instead of bundling everything under ESPN, maybe they want to include it into Disney Plus subscriptions, or make it its own separate model where you can break down various sporting tiers, as I've just described. They are still somewhat torn on what to do. All we know is that they want to call it Flagship, but as to the breakdown as how they're going to break down the service or bundle it up with Disney Plus, that is still what the CEO has to deliver in terms of the final outcome there. Overall, guys, I would be fairly happy with this quarter. The company has had a tremendous turnaround story so far. You can see they got absolutely destroyed during the pandemic, and now EPS is back to somewhat of the pre-pandemic levels. Very nice expansion into the future. They've done a good job of recognizing the problems they had, and now putting forth the steps to turn around the business. Revenue as well, same thing, guys. They did have a little bit of a problem here during the pandemic, but you can see, although they were flat the last few years, we are now returning to growth across all segments for Disney. So they've done a really good job. Now, in terms of the valuation, is it a good buy at 110, still being off the all-time highs now by about 45%? Well, let's look into that, shall we? So at 110, the valuation right now is about a 20.3 forward price to earnings. Not that bad, roughly in line with the S&P's forward earnings. When you divide this by the EPS growth rate of 12%, which is healthy, you get a PEG ratio of 1.69. Not too bad. I wouldn't say it's very cheap, but it's also not very expensive either. It's kind of right there in the middle. Anything under 1 is cheap, anything over 2 is expensive. At 1.7, not the worst, but not the best either. Free cash flow yield, though, when you look at more defensive ratios in terms of the free cash flow of the business, 4.15, that is a very healthy free cash flow yield. Usually you want to see between 2.5% to 5%. As high as possible is better. So at 4.15, it's pretty decent across the top end of the range. And price to sales of only a 2.12 on a forward basis is very good. So when you measure in terms of future growth of the company, now, the valuation is not so good, but when you measure in terms of what the company currently has and the more defensive valuation metrics, it actually paints a picture that Disney, yes, is somewhat decent value over here. So this company gets like a B plus from me. It's not A plus, it's not A, it's not A minus. They still have a few things to work out, a few kinks to work out as well, but overall, not too bad. The only red flag, well, the only problem with the business, guys, is there's a little bit too much debt for me. You'll notice here, if I pull up the debt profile of the company, there's a little bit too much for me overall. You can see here, look at the amount of debt, right? 49.5 billion. They only bring in about 8 billion of free cash flow per year, and they have about 6 billion of cash and cash equivalents. This unfortunately prevents the company from doing much in terms of buybacks or much in terms of increasing the dividend yield for shareholders. They're going to be probably focused on paying down this debt largely over the next 2, 3, 4 years. That is the only major red flag. So is it a deal here? I wouldn't say it's a tremendous deal, but is it a decent proposition if you love the company? Sure, not too bad at all. I would say that most of the problems are now behind us. The future is looking a lot brighter than it has been in the last 2 years. But overall, if I can see this one come down 100 to 90, even I may be tempted to take a little bit of a swing trade. Coming into resistance right now, 120 down to about 115. If we do pull back and consolidate a little bit more on this monthly time frame right there and come down into the lower $100 range, I think that could be a decent little value proposition to probably pick the lows, build a little bit of a position, and look for the expansion of the company. Although it may be slow, it can have some upside expansion into the next 6, 12, 18 months of trade. That's everything that I had for you guys for Disney. Spent a little bit more time on this one because we don't review it that often, so hopefully you enjoyed. Company number 2 is going to be another good one, guys, and we're going to take a look at Uber right now. So Uber coming out today, down 7.56% after their earnings. Well, even though they were down 7.56, their earnings, guys, were very good, and the valuation of the company down here is excellent in my opinion. We'll get into that in a few short moments. So, earnings, beat on EPS, 545%. This is a fake number, however. They pulled forward a tax benefit for the company and also recognized some capital gains from the investments they've made in other ride-sharing platforms across the globe. This EPS number is fake. I'll show you the real one in the article. It was not that bad overall. Revenue, though, increasing 1.72. That was fairly good. So despite having some very decent numbers, Uber was still down 7.5%. Why? Well, let's go have a look, shall we? Uber beat fourth quarter revenue expectations, but offers soft guidance. And soft guidance, you got to take it with a grain of salt. You can argue that Microsoft and Google gave soft guidance, but it really wasn't so soft. But I've told you guys over the last 2-3 quarters, Wall Street is extremely picky with their guidance. If the guidance isn't fantastic and you don't eviscerate it, to borrow words from Alex Karp the other day, if you do not eviscerate your guidance, your stock is not going to move much. Moving on further. So they beat analyst expectations for revenue, but missed on EPS and offered soft guidance. Here's the real EPS number, 23 cents versus 50 cents expected. That is a large reason why the stock is down today. Revenue, though, did beat. Revenue grew 20% in the fourth quarter from when measured from a year ago. Very healthy overall. Now, gross bookings, 44.2 billion in gross bookings. The estimate was which was the estimate was 43.49, so coming in above the estimate for gross bookings. For the first quarter, moving forward, they expect gross bookings between 42 and 43.5. The midpoint estimate from analysts was 43.51. There is your soft guidance, guys. The soft guidance is the fact that the top end of the range is the analyst average. Not that big of a miss on guidance if you ask me. It is soft, but how soft? Not very soft in my opinion. And in terms of earnings guidance, 1.79 billion to 1.89 billion in earnings guidance compared with the 1.85 billion estimate by analysts. The midpoint of this range is 1.84, slightly under the analyst estimate of 1.85. So once again, you can argue soft, but you can also argue that Wall Street is being a little bit picky, right? Now, our performance has been powered by rapid innovation and execution across multiple priorities, including the massive opportunity presented by autonomous vehicles. We enter 2025 with clear momentum and will continue to be relentless against our long-term strategy. Now, the reason that Uber has come down a lot in the most recent months has been this concern that autonomous vehicles will eat into their business and render them obsolete. Now, because of that, Uber has acknowledged this fact and spent literally the first slides of their earnings talking about their implications with autonomous vehicles because the management team recognizes that the stock price has gotten hit because of those concerns. So let's see how they address those concerns, shall we? So moving on forward, their first slides, they never do this, guys, and now their first slides are all for the autonomous vehicle. You can see they're labeling it as well a $1 trillion opportunity for autonomous vehicles overall. Moving on further here, Uber is well positioned as autonomous vehicle tech advances with several partners added already. Waymo, Reride, Pony, AV Ride, Neuro, Aurora, Motional, Wabi, Wave, and NVIDIA. Still possible players to be had, maybe Baidu, maybe Zoox, this is from Amazon as well, maybe Tesla, shout out to Tesla as well, and maybe even Mobileye and a few other companies as well. They are trying to secure these partnerships, but they already have some very decent partnerships to begin with. Now, significant commercialization challenges remain. So you'll see that the management team puts a lot of emphasis on the fact that, yes, robotaxis are most likely the future, but it is a quite distant future, possibly more further in the future than people are anticipating. Special shout out to Tesla here. Tesla vehicle in the background, if you can notice, right? Uber can help AV partners navigate these challenges. Shout out to Tesla. Moving on further. Right? Moving on further, they give some stats right there, but I just wanted to show you guys that they really put a lot of focus on autonomy-driven vehicles in the future overall. Now, they're saying that they can provide the network to help and enable these autonomous vehicle manufacturers or autonomous vehicle companies to access Uber's wide network of participants and get those customers moving forward. So moving on further, guys, I'll show you these numbers, and the numbers were objectively fantastic. Gross bookings up 21% year over year. Long-term forecast, mid to high teens compound annual growth rate. That is fantastic for growth bookings, guys. For a 3-year outlook, that is fantastic. EBITDA as well would be growing on a compound annual growth rate, high 30s to 40% range. And free cash flow, one of the highlights of this company that nobody talks about is how much money they make in a given quarter. It is actually staggering. Even though Uber is known as a growth company, they are bringing in tremendous amounts of free cash flow, which even helps them on even the most defensive valuation metrics that you can use. Look, monthly active paying customers, right? Growth year over year, 14%, very solid. Monthly trips per monthly active paying customer, 3% to the upside, a little bit slower than anticipated, but still growing, right? They're growing into scale. So it's normal. You can't see exponential forever. They're growing at scale. Now, in terms of total trips, that was up 18% year over year, which is absolutely fantastic. Gross bookings, you can see that number right there. There's your 21% headline number. Revenue, because these two numbers are different, right? Even though Uber can have, 44 billion in gross bookings, that is not all their money. They have to pay the drivers, of course, right? So overall revenue from the ride-sharing service is $12 billion, 21% constant currency growth. Guys, nothing bad to see here, right? Fantastic growth from this line of business from the company. Adjusted EBITDA, which is earnings before interest, taxes, depreciation, and amortization. Fancy words, I know. All you need to know is earnings are going up and to the right in a very, very healthy proportion, 44% growth year over year. Now, segment details as well. Mobility highlights, we've already went over those. Delivery highlights, the delivery segment, Uber Eats, right? Gross bookings, 18% higher. Revenue, now 20% higher as well. Same concept, even though they make even though $20 billion runs through the app, that's not all their money. They have to pay the restaurants, they have to pay the drivers, etc. So the revenue overall to Uber is still a cool $3.7 billion and growing 20%. Very, very, very healthy here, guys. And even earnings on those 3.6% increase. So they're increasing revenue and increasing bottom line as well. Freight, a segment that not a lot of people talk about, that is slightly flat. Uber's been struggling with this. They do offer this as a service. It does bring them a decent amount of money, but in terms of earnings, it is a negatively, well, not a profitable segment for Uber overall. So that is pretty much everything, guys, but we're going to focus on the free cash flow here. I know you guys might not be able to see this very clearly. I'll bring it up in the earnings because I've already done the math for you. Not going to look through it. Just understand I did the math. Here is the summary of the liquidity position here, guys. Very healthy cash segment, $7 billion on the balance sheet. Here's their equity stakes, right? In Aurora, in Grab, and in Didi. They also have other investments too, such as Lime, such as Joby. Just to let you guys know, they are investors in a lot of other very popular either delivery networks or ride-sharing services, such as Didi, across different various market segments. Overall, guys, fantastic quarter for Uber. Nothing bad to say whatsoever. Yes, the guidance was a little bit soft, guys, but you're really splitting hairs at this point, right? I do think this is a tremendous buying opportunity, and we'll go over why. So take a look at this revenue growth and EPS growth for the next few years, especially, fantastic numbers for Uber. Look at this EPS and revenue expansion curve. Smooth up and to the right on revenue and even EPS. Uber was not always a profitable company. Now they are definitely a profitable company and expanding EPS nicely up and to the right. And even when you look here, guys, in terms of their free cash flow, this is the highlight of the business that not many people talk about, guys. Free cash flow machine. Look, no debt really on the balance sheet. They have $7 billion in cash, $12 billion in debt. Overall, they can start paying down that debt. Free cash flow in 2023 was 3.36. How much was it in 2024? They doubled it, guys. $6.9 billion in 2024. In terms of the valuation down here at $64, $65, the forward price to earnings is a cool 26.75. Not that expensive for all of this growth, in my opinion. When you divide this by the EPS growth rate, which is fantastic, you get a PEG ratio of under 1. This is amazing, guys. This is a banger deal, in my opinion. And even when you use a more defensive measure, such as free cash flow yield, trading at 5% free cash flow yield right now, that is absolutely fantastic. So when you measure it versus growth or, free cash flow, both metrics show that the company is undervalued right now. And the CFO said himself, they think the stock is undervalued, and as a result, they will be accelerating the rate of buybacks. All good things. So Uber, in my opinion, is it a buy here? Absolutely. It becomes an even better buy if we come into support down there in the $60 range, but I would not be opposed to even starting a position here. Long-term portfolio, sure. Long-term swing trade the next 6 to 12 months, sure as well. I am in this one personally. I bought Leap call options at $60, and I will not hesitate to add any more if we revisit that. Pure value play alone, in my opinion. And the technicals are not looking too bad either. Really trying to hold this lower end of the support range and just monthly healthy consolidation for now. Company growing into its new valuation. And this consolidation has done wonders to bring these valuation metrics down as they improve fundamentals. Fantastic company, very good price as well. Could be a decent one if you're looking for some upside, but of course not financial advice, just my 2 cents on the fact of the matter. And that is everything for company number 2. Now, company number 3 is going to be another good one, guys. We're going to take a look at ARM. So ARM today coming in, they had a fantastic day prior to their earnings. Look at this earnings run up in the last week for ARM, guys. The past 5 days, they're up 15%. So arguably, guys, unless the numbers came in and eviscerated their numbers, right? It's largely that the earnings move was kind of already priced in. So which is why in the after hours right now, ARM is down 6.24%, but objectively, their numbers were good. It's just the stock has run a ton into earnings. You can kind of argue that the earnings bump was slightly priced in already. Now let's take a look, shall we? EPS beat by about 14% and the revenue beat by about 3.5%. This is a company, guys, if you want my opinion on ARM, before we even get into the numbers, I really love this company, but I don't so much like the stock price. Now let's get into the article, shall we? So, chip tech provider ARM narrows the full year forecast and the stock plunges. Once again, narrowing, guys. You can say it's soft, but all in all, guys, once again, Wall Street really being very picky with forward guidance, at least over the last 2-3 quarters for a lot of the tech names. Moving on into it, ARM Holdings said on Wednesday it will no longer meet the top end of its previous full year guidance. ARM does not typically enjoy growth spurts in boom times because it makes money more indirectly from AI than chip sellers, by steadily raising licensing fees for its technology and royalties for each chip other companies sell. I'll remind you guys, ARM is not a chip producer, they are a chip designer. And when they sell the chip designs and the blueprints for those chips, they collect royalties for the entire time that those chips are used in production by other various companies, such as TSM, such as Samsung, and other providers as well. Now, for the full year, ARM narrowed its revenue guidance to a range of 3.94 to 4.04. Previously, the range was 3.8 to 4.1. So they increased the bottom end of the range, 3.94, from 3.8, but they narrowed the top end of the range down from 4.1 to 4.04. I mean, you can argue that that's soft, guys, but is it that soft? Not so much, right? You raise the bottom end, but you decrease the top end. Arguable, right? Moving on further, investors were expecting ARM to raise its full-year outlook with the adoption of its chip designs for AI servers, and with the increased use of its higher royalty rate, ARM v9 design for smartphones. We got that news headline about 2-3 weeks ago where ARM, well, actually more than that, about a month and a half ago, where ARM said that it will be increasing royalties on the new architecture, the V9s. Moving on further, the chip technology provider's latest ARM V9 is used in the chips that power Apple's latest generation of iPhones. Unlike prior versions of the designs, the company has structured deals for the V9 technology to allow ARM to increase prices. Yes, this is true. Prior, ARM would set one flat royalty fee for its previous designs, and that would be the royalty fee forever. In the contract, there would not be a clause for increasing the price on those at all. With the V9 structure, they have changed the royalty structure, and it does allow for increases at any given point throughout the contract. The rates could rise with each new iteration of a device. That is a significant change for the corporation. For the current fourth quarter, ARM forecast revenue in a range of 1.18 and 1.28, with a midpoint of 1.23. So right in there, guys, coming in line with guidance, 1.3 versus the 1.22 expected. Very average in terms of coming in line. Third quarter revenue rose 19% for this current quarter we just ended. Very healthy. The company's designs power nearly every smartphone in the world, and the company has attempted to make headway in data centers and other markets. But in recent years, low-profile ARM has attempted to alter its position in the chip market by raising prices and moving to potentially compete with its biggest customers. It is exploring the niche of possibly wanting to make chips on its own, but we know that that requires extremely heavy investments in terms of facilities and manufacturing processes. Now, in December, ARM failed at one attempt to secure higher royalty rates from Qualcomm. There was a big lawsuit between Qualcomm and ARM in a Delaware court after a week-long trial in which Qualcomm actually won. So let's move into some of the ARM numbers, shall we? Very solid company, but I will explain you. There is one big red flag for me with this company, which has led me away from buying any long-term share position, just because it's not sustainable what they're doing. So moving on further, ARM is obviously a product of is obviously included in the Project Starlink that President Trump announced in Q3. Now moving on, $500 billion investment in AI infrastructure from the U.S. government, and they will be set to provide CPU capability to the data center for that Starlink the Stargate project, rather, not Starlink, Stargate. Revenue up 19% year over year, which was very good. Now, we're not going to go through all these slides. All you need to understand is, you know, you can find ARM designs in every single aspect of the market overall, whether that's mobile, cloud compute, automotive, Internet of Things, and embedded overall. Designs found every single place in time. Let me explain to you a little bit of the business model. You can see revenue is increasing very nicely here, both in terms of royalty and licensing and other revenues. Both segments of the market really doing a good job of increasing over time. Now, royalty revenue up 23% year over year and licensing 14% year over year. Very high gross margin business, and it should be high net margins, but they have one problem, and we're going to get into that. You can see that as the older models are phased out, you get less and less royalty and licensing revenue from the older models, ARM 7 and ARM 8, and now starting to peak into ARM 9, which does have that price increasing scheme. So ARM will make royalties all throughout the life of you using their chip designs, which makes it a very sticky business overall. Now let's moving on further here. You can see their market share. They have tremendous market share of mobile phones. Almost every smartphone in the entire market, guys. very good. Consumer electronics market share, 30%. Cloud compute as well, they have 15%. Networking equipment, 28%. Other infrastructure as well, right? You can see they have a commanding market share in most of all segments of the market in terms of their chip designs being used. Now let's move on a little bit further here. That's what I wanted to show you guys. Annualized contract value is also going up and to the right. Very decent. And remaining performance obligations, how much money they still have in the pipeline, somewhat decent, guys. They still run about 2-3 quarters of run rate ahead. So they have at least have 2-3 quarters of money in the pipeline still to do more deals. Overall, guys, there is nothing bad to see here in terms of either the royalty revenues or whatsoever. Royalty revenue provides a platform for long-term growth. As you can see here, they are still collecting revenue from chips they designed all the way back in 2012. So very predictable and very sticky business overall. Now, I keep telling you guys about the one concern that I have for ARM. What is it? Well, we can take a look here. Revenue growth and EPS growth are very healthy. 18% revenue for the next 3 years, 30% EPS growth, which is extremely solid. Now, that gives them a forward valuation at 161 of a PE of 78.15. It is very high at a first glance, but keep in mind they're growing EPS very quickly, gives them a PEG ratio of 2.6. Very high, guys. That is objectively very high. Even when you measure on a more defensive scale, price to sales, 34.4. That is the highest of the entire semiconductor market overall. NVIDIA, for example, is at 16. So over double what NVIDIA is currently trading at when you take a very defensive price to sales valuation metric and you forget about the EPS growth rate. However, despite it trading rich, that is not my problem with the company. My problem with the company is this. There is too much stock-based compensation. Even though they have fantastic net profit margins of 25.6, guys, what is their cost? Do they manufacture chips? No. They do chip designs. They have a lot of employees. They spend money on research and development to get the new designs, new plans, and all things like that. But my problem with this company, guys, and nobody talks about this, is the fact that they have some of the best gross margins in the entire industry. Look at these gross margins. You're talking about gross margins in excess of 90%, meaning revenue minus cost of goods sold. They don't have any factories. They don't have to machine anything. They don't have to produce anything. They are just a blueprint and design firm. A lot of that money is used in operating expenses. Gross margins of 90%, guys. When you're a software company, a blueprint company, collecting money from royalties and licensing, how on earth can you not bring more money to the bottom line than they're currently bringing in with 90+% gross margins, guys? Nobody has 90% gross margins. We can even go to MasterCard and Visa. They're literally payment networks, right? Even MasterCard and Visa, they have 95% plus gross margins. They're the only other companies that have these margins. And you can see how much money they bring into the bottom line. 45% for MasterCard and 50% for Visa. ARM as well is just it's a company with very low cost of goods sold expenses. So they have a gross margin here of 91%. How on earth do you only have operating margins of only 7.5%? You want me to tell you how? Because they spend way too much money on stock-based compensation. It is actually somewhat quite ridiculous. If you look at their stock-based compensation, which is, let me just find it for you guys real quick. Let's go to the cash flow statement right there. So here's the statement of cash flows, right? Now, 3 months ended, share-based compensation costs, $227 million, yeah? How much of that is from, how much does that represent from total revenue? Well, let's derive it, 227, yeah? So 227 divided by your total revenue right there, which is 983. How on earth are you guys spending 23% of your entire revenue on stock-based compensation? It makes no sense. It's not as if the company is a 2-year-old company. This company is like 15, 20 years old. How still is all of your money going to stock-based comp? It makes no sense, guys. When your cost of goods sold is so low and you have such high gross margins, it is unacceptable, in my opinion, that stock-based compensation represents so much of your operating margins. It is egregious, in my opinion. They could be, even though the net margins are good, guys, imagine how good these net margins would be if they did not pay that much money in terms of stock-based comp. This is terrible for this company to do this. And one of the reasons why I just am not an investor in this company. Great company, great revenue model, but the execution, the stock-based compensation, guys, is a little bit too rich for my liking, which means we have a decoupling here. I love the company, I love their business model, but I do not like the stock price. If they had better stock-based compensation management, they would bring more money to free cash flow, they would bring more money to the bottom line, which would mean more money towards EPS, which would mean this valuation would be a lot cheaper. That is my concern with this company. This valuation, if the stock-based compensation was cut in half, you would possibly see this company trading around a 1.6, 1.7 peg, and a price to sales, which would be, well, the price to sales wouldn't change because that's revenue, but at least the earnings growth number would be a lot better, and what you're paying for future growth would be a lot better as well. So ARM sitting here at about the 160 level, 165 in the after hours here, 162. Guys, I'll be honest with you, I'm not the biggest fan, but the technicals are the technicals, right? So one thing's for sure, they are in a very nice weekly uptrend. They're in a very nice monthly uptrend as well. As we can see, very healthy monthly uptrend. The business will be expanding and the business will be here to stay. If we want to play it purely on the technicals, classic, breakout, retest, and run. If we somehow retest this lower 150 range, it is a buying opportunity, guys, for a possible continuation long, but adding this one as a part of a long-term portfolio, the valuation is not the best right now. I think there's better deals in the market, but overall, is it a bad company? No. Is it a very sticky business model that will be here in the next 10, 15 years? Yes, absolutely. It's just not trading at the best value right now. You would need it to see it come down. If ever ARM comes back down, guys, 120, 100. I'm not saying it will come back down, but if it does come back down there, I think that is the good area to be building a long-term position and be happy with the price that you paid for the stock. So those are my thoughts on all of our earnings that we had today. Sorry, I spent a little bit more time on those, but now we're going to get through the technical analysis portion, shall we? So moving into the SPY, well, we can see, guys, that unfortunately, as I'll just use again on the SPY, not much has changed in terms of the analysis. We know that the SPY is still somewhat in a daily downtrend until the bulls are able to mount a recovery rally and reset the daily uptrend. All in all, it's not looking too bad. On the weekly, you can argue that this is some form of a bull flag as well. Weekly downtrend, nice engulfing move. Now a slight weekly bull flag leading down into the 12 EMA and possibly looking for some expansion. If Amazon earnings come in good tomorrow and lift the entire market into Friday, I would not be surprised to see the weekly candle close close to the all-time highs. So the bull's looking quite pretty right now, but all things considered, it is still a daily downtrend. If we start trending lower for XYZ reason, tariffs, or whatever might come our way, keep special attention on 590, break 590, daily downtrend continues, and we would still be hunting for our weekly higher low, anything pretty much above 575, looking for that higher low for further trend continuation. If we break down, I'll remind you guys, the next level of support is down here, 585 down to about 580. All in all, no major red flags on the SPY as I can see just yet. Onto the Qs right now, same concept, right? It was a daily downtrend, nice engulfing move, but the bulls still have not set the daily uptrend back in motion. We are still somewhat in sideways consolidation. Pay special attention to this candle right here, the high of last Friday, 531.59. If you break that to the upside in the next coming days, daily uptrend is set, and we start attacking the high end of the resistance range, which is 535, 536. However, lose this and just consolidate further, well, we just go back into this tightening range that we've largely been trapped in for the last month and a half worth of trading. The support area below is 515 down to about 510, and any retest of this area could be providing a great buying opportunity across many different tech stocks in the market. On the weekly, same setup as the SPY. Weekly downtrend, nice engulfing move, looking for the weekly higher lows to reset the uptrend. If we break down lower and head further into the daily downtrend, we are still looking for a weekly higher low. Anything above 500, we'll be looking for that higher low for possible further trend increase. Now, I'll remind you, whenever we come down between the 12 and 26 EMAs, it has been a decent buying opportunity for the Qs, at least when you measure across the last 2 years worth of rally. So in the event we can find the Qs back down here, some point through February or early March, I will be a buyer at that location to the maximum downside, in my opinion. It's possibly 400 down to about 495. Moving on to the XLF financials right now. Financials having a very good day. So daily uptrend is looking to be set in motion by the bulls. They had the daily downtrend going on here. Big engulfing, one leg of rally here. Higher lows are set. Now we're looking for the expansion, and that would be a break of $52 to the upside. If we cannot break and we roll over and flush the lows of Monday, that would be 50.5. We're going to be looking for daily downtrend, and that would just be synonymous with weekly consolidation. Good thing the bulls have tons of space right now. It was a weekly downtrend, engulfing move. Now you need to reset the weekly uptrend, looking for a higher low for further trend continuation. So If you lose the daily, no panic is required, guys. The weekly bulls are still well in control, anything above 47, looking for a weekly higher low for further trend continuation, or rather trend recapture by the bulls. And similar to the Qs, at any point in time when we come between the 12 and 26 AMAs on the weekly time frame on financials, it has been synonymous with a decent buying opportunity, at least since measured from October 2023 lows. Moving on to healthcare right now, healthcare finally getting the break and close above. So we were kind of commenting on the fact that healthcare was getting a little bit stuck here at the recent highs, roughly 147.50. We have now convincingly broken above that level. So this has been one very large, nice daily uptrend. There was some sideways consolidation to be had here, and now the uptrend continues with this break and close above higher. Your daily higher lows are now set at 145, so any move lower, just gonna be looking for a daily higher low for possible further trend continuation. If you can put in a little bit more space, you can then use this area that was challenging as support for the good old breakout, retest, and possible rally trade. Now, in the event we give up this entire move and roll over into a daily downtrend, just keep in mind who is looking to establish new control. The bulls. Weekly downtrend was in motion for about 4 or 5 months. Big engulfing move on the weekly, MACD crossing right now, so it shows you the bulls have the momentum control. Engulfing move, any move lower on the daily. If you sacrifice and lose this daily uptrend, you will be looking for a weekly higher low for possible reset into a daily uptrend. And I'll remind you, what is this pattern, guys? If you do this, that would be the infamous cup and handle, which is a very high probability trade, especially if you break above the highs and then use the local highs as support after you break out of them. Retest, that would be a heck of an entry for some continuation on the healthcare sector. All in all, no major red flags. The bulls are looking quite healthy. Moving on to semiconductors right now, although they did have a good day, 2.35% to the upside. Oops, I moved the resistance box. Anyways, that resistance box stays put pretty much from 260 down to about 250. So although we have made some good progress off the lows, still no clear trend. Need a break of 251 to reset the daily uptrend. But then we're going to be encountering resistance, 260 to 250. It's been problematic for the bulls for the last 4 or 5 months. We will see if they are finally able to mount a rally and break above this resistance line. I'm not willing to call it just yet. We can very easily just get shot down from resistance, as we have been many times over the last few months, and nobody would find this very strange, would they? That being said, got to pay special attention. Do not want to break these lows, 235, break the lows to the downside. Unfortunately, daily downtrend continues, and you end up in the last line of defense for the bulls, 230 down to about 220. Overall, still trapped between two levels, overhead resistance and below support, which is a perfect opportunity to be writing short puts on my favorite semiconductor stocks under the market. When we are trapped in a range, I identify companies that are down in semis that I like to play, such as NVIDIA, TSMC on drops, and even Broadcom on drops as well. And I'm just writing short puts under the market because we know largely the entire sector has not been trending for the last roughly 3-4 months. And as a result, it's a good opportunity to play one of my favorite strategies, which is writing puts. Whenever you have a sideways market, possibly not the best opportunity for short-term calls because you are directionless, but it is a good opportunity to write puts under the market and farm some juicy premium in some ideal locations across my favorite stocks. Moving into the Russell right now, Russell making an attempt, and the Russell really benefiting from not only broad market recovery, because we know the Russell sector weightings, kind of look like the Dow Jones a little bit, right? They have a lot of money in the financial services sector, 17, industrial 16.5, healthcare 16.25, tech only 15.6. So when you have a broad-based market rally, the Russell really comes alive. Couple that with declining 10 and 20-year yields as of recently, and the small cap stocks have a good chance to put together a run. It was a daily downtrend. The bulls are looking to engulf, coming into resistance right now, 232 down to 225. Best case scenario for the bulls, give me the engulfing move and break through resistance. If you can break through resistance, you can then use that resistance zone as support and try to manifest a rally similar to kind of what happened back here. You want to see the engulfing break, retest, and run. There's two possible trades here. If we roll over and revisit these lows, I might be looking to position down here, 215 down to about 210. The other trade is the break and retest. If you break and retest, this could provide a nice entry opportunity. Stops would go below the lows, and then you are targeting the highs for the breakout. Those are the two possible setups that I'm seeing right now on the Russell. When you look on the higher time frames though, you see the price has been very sticky in this region. So you really need to see that weekly uptrend breakout, retest and run to give yourselves the best chances of marching towards new all-time highs. And now lastly, the Dow Jones. Dow Jones up about 0.71% today. You know, fairly decent day for the Dow Jones, all things considered. Same setup as financials. Higher lows are set and looking for the higher high expansion, which would be a break of the all-time highs, which is 45,000 roughly. So we're going to be looking for that all-time high break. We will see if the bulls have it in them to get it done by the end of the week. In the event they don't and we roll over and break the lows of Monday, the tariff day, well, that would be daily downtrend. But is it that big of a deal? No. Who's in control of the higher time frame here? The bulls. Weekly downtrend, huge engulfing move, tons of space off the lows, anything above 41.9, let's call it. Going to be looking for a weekly higher low for further trend continuation. So if we do break down here, guys, just want you guys to understand, we're looking for a retest of 43.3 all the way down to roughly 43,000 on the Dow, which would just be a retest of the 12 EMA and horizontal support. Very nice breakout retest and possible run setup. So if we do break down here on the Dow, I will maybe look to participate in several of the companies that are inside the Dow Jones myself. Now, overall on yields, we have seen that recently today, we had a 2% drawdown, and we were noticing, guys, that this was a nice head and shoulders pattern. You're finally starting to get that follow through to the downside and finally starting to get a wider move to the downside in terms of the weekly timeframes. It is still a weekly uptrend on yields looking for a higher low. But if we come down, 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 all the momentum gets erased. They will eventually set a lower high, but then even on the weekly, guys, you could be setting yourselves up for the weekly head and shoulders pattern rollover. I don't want to speculate too much. I don't want to get ahead of myself, but the pattern is not looking too bad. But as of right now, just looking for a higher low, and then we'll see, can the bull set the lower high into the weekly downtrend? Or will yields just start trending higher with some unfavorable inflation results, some unfavorable tariff results as well? Still a lot of time left on this trade. The 20-year yield is the exact same setup, guys. Head and shoulders on the daily, nice rollover, but weekly, still in a weekly uptrend, looking for the higher low. If they pull back hard down here, all momentum is gone. It favors for the lower high into rollover setup, but a lot of trade left on this one. Not willing to call it just yet, but looking good. All things considered, this does open up a nice opportunity for the bond trade. I had said back here, nice entry for bonds. Even here, nice entry for bonds. This is the inverse of the yields, pretty much. Inverse head and shoulders. And now finally, TLT coming back to $90, a level we have not seen since the day before Jerome Powell obliterated us on the 18th of December. That being said, overall, guys, looking for a higher low on TLT for possible further trend continuation, but is all predicated on the same thing for yields. Can we set the weekly downtrends in motion? And that will conversely set up a weekly uptrend on TLT, something we have not had since the month of September. All things considered, it is not looking too bad. Moving into Bitcoin now, well, crypto has been a little bit muted. We constantly are waiting for the SBR announcement from the government. Still no announcement of a strategic Bitcoin reserve. That being said, daily downtrend right now is somewhat clear as day, moving to lower lows and still trapped between two ranges. Overhead resistance 101 up to down to about 98, and below us 91 down to about 87. So when we're range bound, I'm a big fan of whenever we test the lower end of the range, I'm writing short puts below the market using my favorite ETF, which is BITX. In terms of the weekly timeframes, we're still just chilling, guys, just somewhat of a tight range of accumulation near the all-time highs, which is not the worst case scenario, but eventually you will want to see a break and close above the 105 area. As of right now, though, still somewhat a little bit muted on crypto. Crypto, guys, I mean, people are just very impatient in the crypto sector, right? They want that headline announcement. They want the strategic Bitcoin reserve. They're not getting it. So now we're starting to see some winding down of some positions after the inauguration as we are just not getting the headlines we deserve. But if the SPY QQQ and other risk-on assets do continue to move higher throughout February and March, Bitcoin most likely will play a little bit of catch-up. Overall, the chart is not looking terrible. I am still a big fan of bidding at these lower ranges here, 91 to about 88, all things considered. Moving on to ETH, well, ETH did a good job of recapturing the disaster that was the liquidation sell-off of the Monday candle. But we can see ETH and even altcoins are still notoriously weak in relation to Bitcoin here, guys. And that has to all do with the Bitcoin dominance chart, which we bring up several times per week on the channel. You'll notice, guys, Bitcoin dominance now weekly uptrend, and we're just back to this kind of uptrending channel. We had some form of an altcoin rally as people tried to front run Bitcoin dominance coming down, but Bitcoin dominance back up here, guys. You're going to have to wait a little bit longer if you want to position in those altcoins. Decent levels to position in the altcoins right now because let's be honest, they are crushed. They've given back all of the moves since the election. Decent time to be bidding. But if you want to see the altcoins come alive, one thing has to happen first. Bitcoin needs to give you the next leg higher. Only then will people be able to make a lot of money on Bitcoin, take that money, and then rotate into the altcoins. But as of right now, still weak. But I do still like bidding Ethereum down here in the lower 26 to 25 region. The ETF that I'm using, there's several of them, but the one I like to use is the 2x leverage ETF and try to buy it as close as possible to $4, which is synonymous with that lower range right there. A decent area to be writing some short puts, which is why I've been writing some short puts in the lower $4 range on ETH. So keep that in mind. That's just the way that I play Ethereum. Of course, I also have some spot crypto in terms of physical crypto overall, but those are just my thoughts on the crypto market overall. Now let's dive into some big tech names, shall we? All right, so we're going to run through these a little bit quickly because honestly, not much has changed except for Google, really. So Apple, starting off with Apple, daily downtrend, yes. Daily uptrend for the bulls, yes. Higher lows are set and now looking for the expansion. The only problem is we're coming into resistance right now, 237 to 231. If they can clear this area of resistance, they have a better and better chance of starting to recapture the levels. Resistance has been a problem for the bulls in the last roughly 5-6 months of trade. And if ever we get rejected at this resistance and break the lows of pretty much the Monday session, that would be a daily downtrend, and we'd be looking at these bulls to act as support, 225 down to about 215. So we're really trapped in a very tight range, similar to what happened back here, trapped between overhead resistance and below support. If we drop into support, I think it's a good time if we pull into the 220s or lower to be writing some short puts on Apple, 215 down to 210, which is where I would not mind bidding this stock myself. But if I do want to bid this one, I have to get a good price, guys, because the valuation and the revenue is a little bit rich right now. The valuation, a little bit high, free cash flow yield on the lower end, and they're not growing revenue as fast as they once were. So the valuation is a little bit problemsome. However, fantastic company is Apple, and we're getting very close to the 200-day EMA. Usually when we bid Apple around the 200 or slightly below the 200 in the context of an overall bull market, you can see that traditionally, I mean, this is the bear market of 2022, but traditionally in a bull market, it is a decent area to bid a little bit of Apple at or around the 200. So that's the area that I'll be targeting if we break down, looking to write some short puts a little bit down below there, where the valuation is a little bit more manageable. Moving on to AMD right now. So AMD coming off the lows after their earnings. We covered their earnings yesterday and they hit a low today of 106.84 before coming in with a very nice bounce. But a bounce is only that, guys. It is only a bounce. Step number one is confirmed. Confirmed the hourly uptrend. That is nice. But the context is still many downtrends, guys. Monthly downtrend. Weekly, big downtrend as well. And daily, simply a daily downtrend too. So the bulls have to start everything from scratch. That being said, I think there's good value down here. 112 down to about $98. We did the valuation yesterday, 0.57 peg, guys. It's extremely cheap for the growth profile of the company over the next few years. So I will still be playing AMD down here. As a matter of fact, I did play AMD today. $100 strike with about a month worth of time. I'm already 50% profitable on that contract. I told you guys I would be buying the dip, but buying the dip conservatively. And buy the dip, I did. $100 strike, writing short puts under the market. And now we're getting a nice bounce. But the bulls have a lot of work to do, guys. They have to first get the daily uptrend back, and then eventually also start working their way into getting the weekly uptrend back. All of that can be somewhat of a lengthy process. So I like bidding AMD down here, but I'm not ready to call it the bottom until we see the bulls recapture the weekly uptrend. Only then will you know the temporary bottoms are indeed set. So as of right now, I'm bidding down here lower 100s, but I'm not willing to call it the absolute bottom just yet. So you have to be somewhat patient. If you are playing this stock, it could be a decent opportunity for some leap call options as well. But I'm putting a lot of time on them, guys. June 2026. You got to get this company, you got to give this company a lot of time to recover and carve out a little portion of the market share that they should be carving out over the next few quarters. Moving on to Amazon right now. Amazon, tough to say, guys. They're down 2.43 today because of the less than spectacular Google numbers from cloud. They were equally down after Microsoft's cloud revenue, which posted last week, which also missed the expectations. So Amazon has earnings tomorrow, guys. Very tough to derive price action. The best I can tell you guys is to look at the expected move. Now, I will be playing Amazon earnings by means of writing short puts under the market. The expected move right now is about 5.75%. So that could take us all the way back down, right back down into here, 225. And if they come any lower, guys, the big area of support is 215 to 210. This is where I will personally be bidding tomorrow for their earnings, looking to write some short puts, either 220 down to about 215. That is my personal sweet spot. Very tough to derive price action, of course, into earnings. If they smash it 5.5% to the upside, we'll put them just above 250. Looking forward to see what they have in store, but a lot of the focus is going to be on the AWS growth numbers because we know a lot of focus was put on that for Google and Microsoft combined, right? Weekly uptrend. If we get shot down on earnings, I'll remind you, looking for a weekly higher low. Anything above 216, looking for a weekly higher low for possible further trend continuation. Amazon is set up really nice into earnings, and they should be having a fantastic year. So looking forward to sharing their earnings results with you guys tomorrow after the close. Into Google right now, down 7% after their earnings. So reacting very nicely. And I was saying that today I was going to go shopping for Google, and going shopping I did. So we wrote some short puts down there, guys, in the 185 region below the support range. And now our short puts are doing quite well as we kind of attack this one. First thing early on in the morning was looking pretty good. We got some decent premium, but all things considered, the stock is reacting nicely from support, which is 192 down to about 187. Still not losing these lows. Have we lost a daily uptrend? Yes, we have lost it. Now the bulls have to fight and get it back. You need to see a very nice bounce, high, higher low, and then recapture of the daily uptrend. If you only set lower high into lower low, yes, you can be possibly looking at breaking lower. You can even break lower from here. Would it be that bad of a thing, guys? Not really, in my humble opinion. You have a lower end of support 187, but even if you pull lower, guys, and sacrifice a little bit of this weekly momentum and the weekly uptrends on the monthly time frame, here is who's in control and the clearest time frame of them all, in my opinion. Gorgeous monthly uptrend expansion. If we pull lower into the low 180s, 182, 180, 178, that will just be looking for a monthly higher low for further trend continuation. The chart would look quite manageable at that point, which is why I still favor the lower 180s as my desired destination to be picking up some Google shares. We did the valuation yesterday after their earnings, and the valuation is still very, very cheap right now at a cool 1.43 peg and a forward price to earnings of 21.4, which is roughly in line with the S&Ps, even though this one is growing faster than the S&P. Moving on to Meta right now. Meta with another day to the upside, but pulling back off the day highs, which is about 717. Meta is looking very good right now, guys. One huge daily upswing move. As soon as this move is topped out, we're getting a little bit overbought here on the daily. Keep an eye on the hourly trend though, guys. If you do not lose the hourly trend and do not lose the 12 EMA consecutively, right, you cannot say this move is done. It's getting a little bit rich. I would not be surprised if Meta does take advantage of maybe the next few days to consolidate a little bit. I'll remind you though, anything above 604, looking for a daily higher low for possible further trend continuation. Even if we lose the uptrend on the daily, guys, the weekly bulls have created so much space off the lows. 590 weekly higher lows, looking for a weekly higher low for further trend continuation. That is if they lose the daily uptrend and start their consolidation phase. So much space on the weekly, and it's just been a beautiful weekly uptrend, arguably this entire time for Meta. Tons of space here, and I would not mind playing a retest of the 650 to 640 range. I don't know if we're going to get it. All I'm saying is if we do get it, I'll probably be looking to play for a little bit of classic breakout, retest, and maybe run throughout the rest of 2025. Moving on to Microsoft right now. So Microsoft still relatively weak after their earnings, but kind of looking to find a local bottom. Still trading below the 200-day EMA and very close to our support range, which is 405 down about 390. This is a heck of an area of support, guys, and I love, love, love bidding this stock through the intermediary of selling puts under the market on Microsoft in the lower $400 range. If you do not have the capital to write puts on Microsoft, because it's a fairly large contract, I will admit, you can also use their 2x leverage product, which is MSFU. Since it's 2x leverage, you got to be a bit more conservative on the strikes, but all in all, Microsoft does not move in such a violent fashion. So although there is decay on this contract, I wouldn't say it's as aggressive as a TQQQ or an SOXL or things like that. You can still play it in a conservative fashion for a lot less money than playing actual Microsoft. That being said, still no trend in motion. Same thing as AMD. Big earnings drop, need to reset the daily uptrend, and let's see how far we can bounce. If we do bounce here, guys, we're coming into the 425 to 435 resistance range, maybe looking for a lower high. Then it's up to the bulls to reset the daily uptrend pattern, similar to how they had to do it back here, right? It's going to be a two-step process. I'd be highly surprised if Microsoft just one-time V-shape engulfs. Anything is possible, but probably a two-step process of recovery on this stock. The whole time it's down here, decent time to add to a long-term portfolio, but also very decent for a swing trade. And I will remind you, I do have leaps on this company for June of 2026. I am looking for that expansion into the high 400s and even low $500 range. Moving on to Netflix right now. Netflix breaking above their highs in a very big fashion today, over $1,000, $1,011. Still no stock split announcement though. So breakout after earnings, tight range of consolidation. Now you get the breakout. So nice, beautiful daily uptrend from the bulls right now. Higher lows are set at about 963 and now looking for the expansion overall. You got to target psychological levels at this point, $1,050, $1,100 psychological round numbers. In the event that Netflix pulls back, looking for a higher low for further trend continuation. And even if they roll this entire move over, guys, into a daily downtrend, is it that bad of a thing? No. At a certain point, we will just be looking for weekly higher lows for further trend continuation, which is why I'm a fan. If we do somehow pull back on Netflix to the 935 to 895 range roughly, previous resistance, current support at the 12 EMA, I'll be looking to make one of my favorite trades, the good old breakout, retest, and run trade, also known as the trend continuation setup. Now, moving on to NVIDIA. NVIDIA up about 5.21% today. Very good day from NVIDIA off of those renewed and increased CapEx numbers from other big tech institutions overall. And NVIDIA right now looking to reverse this daily downtrend, almost fully engulfing the last leg here, which culminates at the highs of 127.82. If they do engulf this entire move, it's good, but you run into resistance very quickly, kind of like Microsoft. 135 down to about 130 is going to be that area of resistance. If we can pull up here, get rejected, but still engulf, it sets us up nicely to reset into a higher low and go for the daily trend change. I would be surprised if NVIDIA can break through this entire area in one clean move, but at the end of the day, it is NVIDIA and it can surprise us more so than not, right? In the event we fail and retest the lows, below support currently is 118 down to about 112, and below that is 105 to about 100. I'm still a very big fan of playing short puts, guys. Pretty much 110 down to 100 as low as you can get. Decent buying opportunity for NVIDIA, in my humble opinion. This company has earnings coming up Monday, the 24th of February. Although they have lost the weekly uptrend, guys, focus on the longer term timeframes here. We are just looking to set up some monthly higher lows for further trend continuation, and they've done a good job of respecting the 12 EMA ever since they started this rally in January of 2023. Nice higher lows being set. We will see if they can put together a nice rally, but what this has done, this recent consolidation, it has cooled off a year and a half, guys, almost, of extended monthly RSI levels. We are now at manageable levels, although still overbought. So now we've cooled off the timeframes, cooled off the weekly time frame as well. Now this could be a perfect opportunity to find some local bottoms. It may be bumpy, but we are trying to establish some local bottoms. That is why I still love playing NVIDIA in these lower locations. I have a leap contract on NVIDIA, decent location to bid down here as well, and also playing short puts under the market. I am not opposed to, as I do like their valuation down there. Now moving on to Tesla. Tesla down 3.58, coming dangerously close to breaking the 375, 371 area. If you flush this range, daily downtrend continuation, and also the establishment of a weekly downtrend as well. At that point, you'll be revisiting the 360 to 330 level, which is the closest area of support. Not a very strong one, I will admit. The strongest one starts at about the 300 level. I'm not saying we're going to go down there. I'm just saying this one is less strong than this one down there. Pay special attention to if we break 371 by tomorrow and close a weekly candle down there. The bulls need to get their butts in gear and start engulfing this move and reset into a daily uptrend, but so far, no signs of that. So as of right now, I'm not bidding Tesla, but if they do break down, I will start bidding more and more aggressively by writing short puts under the market, targeting the lower end 330 down to about 310 all the way down there. Would not be opposed to be playing Tesla. We would just be looking for a little bit of monthly consolidation, kind of like NVIDIA, right? Looking for the monthly higher lows for possible expansion later into 2025. That wouldn't look so bad, would it? I know it would kind of ruin the short-term momentum, but the chart really wouldn't look so bad. Tesla does this often. They have to consolidate on the monthly sometimes before putting in a new leg. So that just might be what we're looking at right now. I'm not willing to call it though, because they have not lost this range. But if they do lose this range, this entire range becomes resistance, right, for the markets. And that's why we could be seeing a little bit lower. On to Palantir right now. Palantir is still consolidating after their earnings. I mean, not too bad, right? But Palantir is in blue sky breakout territory right now. I was telling you guys, watch the hourly time frame, right? If we continue breaking down lower, it's very easy to see what the bulls are doing. We're just looking to establish some daily higher lows. Beautiful daily uptrend, as we can see, looking for the higher lows for possible further trend continuation. Very tough to gauge where this one will come down into to have its final settling point. But if we wait for the 12 EMA to catch up, you could just be looking at maybe some mid 90s, low 90s type of thing, where they make a big move higher and then just consolidate sideways until the 12 EMA kind of catches up, which is why I'm kind of saying, right? Anywhere between here and the mid 90s could be a local area of consolidation. I'm not saying they're going to fill the 23% gap, but can we see some sideways action while Palantir grows into this new valuation? Very possibly. All in all, though, the weekly is looking fantastic, and any extended consolidation would just be something like this, right? You'd just be looking for a weekly higher low, and then we will revisit the expansionary phase again for Palantir, maybe after some of that consolidation has taken place. But the bulls are looking very, very healthy, guys. It's just not the best value proposition to be buying the all-time highs here for some continuation when the valuation is so high and when we're really overbought here on the short-term timeframes. And now lastly, SOFI. So SOFI coming in at 1.31% to the upside. Not too bad for SOFI, guys, but still trapped in this daily downtrend. You really need the bulls to do one of two things, right? Either engulf 1655 and reset, or at least give me a much better bounce and reset the daily uptrend from there. Overall, though, daily downtrend is maintained, which means we are still in the process of weekly consolidation. Who is in control? The bulls, looking to make an attempt. Anything above 1357, looking for a weekly higher low for possible further trend continuation, reacting nicely from the 12 EMA, acting as defense, and this whole support range too. I'm still a very big fan of writing some short puts on SOFI on red days towards the lower end of support, talking about 14, even if we come down to the lower end here, 13 if you can find it, guys. 13 to 12 is really the area that I would love to buy SOFI at again. I don't know if it's going to get back there, but in the meantime, I am playing some strikes such as the 14.5 and the 14s, writing some short puts. I also do have some call options for SOFI for the end of 2025, looking for that infamous expansion into $18 to $20. The structure is still looking fairly decent on this stock. We're just in the form of monthly consolidation, kind of like Tesla, kind of like NVIDIA as well. Just some very healthy monthly consolidation after two banger months leading into the end of the year. Just a little bit of sideways consolidation, respecting our support zones, maybe looking to just accumulate and then eventually distribute to the upside. We'll take this one day at a time. Either way, I'm fine. If it comes down lower, I'll buy more. And if we expand, I do already have exposure to the upside. That is everything for today's video, guys. If you enjoyed it, consider dropping a like. Would really appreciate it for the growth of the channel. Also consider subscribing to the channel if you're new. I mean, I know we're not close to 10K subscribers, but I thank you guys so much for the 5K milestone that we hit just a few short weeks ago. It's been a hell of a journey with you guys so far. I've loved every moment of it so far with you guys, and hopefully you've appreciated the content as well. So if you're new to the channel and you like this type of stuff, please consider subscribing. And lastly, if you have any questions as per usual, please feel free to leave them down below in the comment section. I will get to a ton of questions over the course of tonight. So if you have any pressing matters that you want to discuss with me, always feel free to leave me a question. I always answer pretty much every single comment in the comment section. And lastly, if you guys are interested in the private trading Discord group, if you want to have access to all of my trades in real time, whether they're the wheel trades, short puts for the wheel, call options, call debit spreads, put credit spreads, leap call options, long-term portfolio trades, I give all types of trades in the Discords for all account sizes as well, whether you have a $5,000, $10,000 account or a $100,000, $500,000 account. There is definitely something for you in there. These are all the trades since the inception of the Discord. The green check marks are the wins, the little red circles are small losses, and the targets are assignments for the wheel trades, most of which we always get out at some very juicy profits. These are all the trades since the inception of the Discord. You guys know, if anything, I'm usually always very transparent with my wins and my losses, and it's been a very profitable journey for myself and our Discord members so far. Now, moving on as well, we do private morning live streams every Monday through Friday before the open for about 1.5 hours to 2 hours every day, where I trade live and take all of your guys' questions on your stocks and your options as well. In the event you cannot attend the live streams, they are all recorded, and you can also ask me all of your questions in our chat rooms, and I'm always very happy to respond and very quick to respond as well for your questions on your stocks and your options. We also have private videos where I go through advanced level strategies that I do not share on YouTube for either small accounts or big accounts as well. And also psychology videos, how to quit your job, how to grow an account from small to big, or even large account strategies that I do not share on YouTube as well. Members have found tremendous value from these private videos too. And lastly, you also get access to all my charts. If you guys like my charts, my technical analysis setups that I give all the time, you can just literally copy paste my charts in the click of a button. You also not only get access to my charts, but all of my watch lists, the options watch list, the large account watch list, the high conviction, high quality watch list, and anytime that I annotate a stock for earnings, such as on Amazon or such as on Uber and Disney like we just did, all of that comes copy pasted on the charts with a click of a button. And a lot of members have found very good value in that as well. If any of that interests you guys, the link to the Discord is always down below in the description. And if not, well, I guess I'll see you back on the channel. Thanks so much for watching once again, guys. That's it for me. I'll see you tomorrow after the close. Have a great day of trading and peace.